ETFs and mutual funds are similar in many ways, but they do have their own defining characteristics. And index funds, which can be ETFs or mutual funds, have additional features to consider too. These characteristics can be beneficial or negative depending on your situation. That's why it's important to create at least one investment goal if you haven't done so already. Goals can help you identify your investment needs, which in turn can help you determine whether an ETF, mutual fund, or index fund is the appropriate investment to meet those needs. Let's look at some considerations when deciding your investment goal and what type of fund to invest in. We'll compare the characteristics of the three types of funds in relation to each specific consideration. What are your investment objectives? Actively managed ETFs and mutual funds both seek to outperform the markets. Passively managed index funds aim to match the performance of an index before fees and expenses. How much are you investing? Mutual funds often have minimums that limit how small of an investment you can make into the fund, like $25 for example. These minimums can vary from fund to fund. You can also buy fractional units, allowing you to invest every cent. ETFs have no imposed minimums to invest per se, but you have to invest enough to buy at least one share. Index mutual funds have investment minimums. For index ETFs, the minimum is to invest the price of one share. Do you want to reinvest distributions? An automatic dividend reinvestment plan, or DRIP for short, is available for most mutual funds, ETFs, and index funds. Most brokerage firms only allow whole shares of an ETF to be purchased using DRIP. However, mutual funds and index mutual funds allow investors to maximize their reinvestment opportunity by buying fractional units. For example, if you received a $25 dividend from a mutual fund, you can reinvest the entire amount no matter what the price of the fund is. But if you had an ETF that currently trades for $100 and you received a $25 dividend, this amount is not enough to purchase one share of the ETF, and the dividend will remain in your cash balance. How will you add to your investments? A systematic investment plan, or SIP for short, is an automated way to buy units of a mutual fund on a periodic basis. SIP is available for most mutual funds. However, the fund may have investment minimums that you would need to adhere to. Typically, mutual fund companies don't charge a transaction fee, which can make SIPs a convenient and economical way to automate investing. However, your broker may charge their own commission or transaction fee, so be sure to check with them. Note: a SIP is not available for an ETF, and investments must be made manually. What are the costs of investing? Mutual funds would use a management expense ratio, or MER, to show all their annual expenses as a percentage of the value of the fund. Again, depending on your broker, a transaction fee might also be charged. ETFs will also display their expenses as an MER, which is usually less than the MER when compared to a mutual fund with the same or similar investment goals. Many brokers will also charge a commission for each trade. Index funds also have their fees displayed as an MER. Because they're passive investments, their MER is typically lower than the MER for actively managed ETFs and mutual funds. It can be common for index and mutual funds to have no transaction fees, but always refer to the fund's prospectus to be sure. For index ETFs, a commission is usually charged for each trade, so refer to your broker. These considerations are just some that you have to think about as an investor. Let's look at an example to see how an investor may decide which type of fund to invest in. Ken is starting to invest for retirement. He'll be contributing $50 every 2 weeks to his RRSP. And he wants to invest that money into a managed fund that follows the S&P 500 index. Should he choose an ETF or mutual fund? If you recall from earlier, fees and transaction costs can be very impactful when investing a small amount at a time. Ken should check each prospectus and compare the MERs, as well as check with his broker to determine the fees and transaction costs involved with both choices. In this example, Ken chooses a mutual fund with no transaction fees to avoid paying a fee every time he makes a purchase. This was a very simple example, and your situation may be more complex. However, It's important to remember that setting an investment goal can help answer questions like, how much money do I have to invest? How often can I add to my investments? And what are the costs? The answers to these questions will determine your investment needs and help you choose an appropriate investment product.